Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Hartford Funds recently published survey data which explored investor sentiment, understanding of elevated inflation, and the role of the Fed, and how that impacts investors' investment decisions. Joe Boyle, fixed income product manager at Hartford Funds, joins me to discuss how younger investors are approaching the market. Jim, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. I appreciate you having me on today.
You got it. And let's talk about the survey. What was the methodology behind it?
So we surveyed over 900 investors with at least $75,000 in investable assets in the middle of February to get their investor sentiment and understanding on, the inflation environment today, the role of the Fed, and how that's really going to impact their portfolios going forward and their investment decisions.
And Joe, what should investors keep in mind as they evaluate their decisions around their investments and day-to-day finances, particularly younger investors who have never lived through an inflationary period?
Yeah, to me, when we read through the survey results, some of the results were very surprising, but some of them weren't surprising to me at all, and particularly the ones that surrounded this new inflationary environment and how younger investors were impacted, because it makes perfect sense for a lot of reasons. It's so front and center because it's affecting everyday basics, the cost of food, the cost of energy. And I know we take a lot of those metrics out of to smooth out the volatility, but the impact of those costs are very real, and they're very real for everyone. Whether you have a family or you don't, you still have to eat, your home. Corporations still have to, transportation corporations, they still have to pay for fuel to get the food to the store. So these are really impactful costs, and 94% of the respondents said this was elevated inflation was their chief concern. And this is the one that wasn't surprising me. I actually thought it would be closer to 100%. But when it comes to this particular problem, this is where we, recommend developing a financial plan or sticking with a financial plan with your long-term goals and objective. We take it back to that. Do you have a plan? These huge higher prices, they came quick. They might subside, they might not subside, but you're not going to get ahead of it in one day. You're not going to get ahead of it in a week or a month without taking some serious risk. And that's not a great idea. So let's revisit your plan, or let's sketch something out for you. It can always change based on your circumstances. It's not a static plan, but if you're thinking day to day, this is when you're going to make a lot of mistakes. So, even the most seasoned, sophisticated investor, they're going to get caught off sides at some point in their career. But their longer term goals, their discipline, that's going to help them get through a rough patch. And that's why we take it back to what's your plan, what's your goal, what's your objectives.
And Joe, that's a perfect segue into my next question. Why is it important for younger investors to educate themselves on the nuances of the current market dynamics?
Yeah, so one of the responses was, while they could identify what inflation meant, I think 75% of the investors could correctly identify the definition of inflation. Younger generations actually struggled with, defining what to do with it compared to older generations, because number one, younger generations just haven't lived through it. They've never seen a huge uptick in prices so quick. So the market dynamics, the nuances are extremely important. And if we stick with the inflation environment we're in, I would say, commodities, they may very well set the standard for total return by the end of the year, by the end of 2022. But a significant allocation is not appropriate for most investors due to the volatility asset class. We're looking at the index, the broadly used index is up 50% for the trailing 1 year. That's fantastic. But if you look over the longer term, 10-year trailing, it's actually negative, which is remarkable when you think about it. You have a year where you're up 50%, but 10 years you've been negative. So it's really boom bust. It's not appropriate for you to hop in and try and chase the commodities trade. But at the same time, if you're looking for that more steady, conservative, rate of return, you might be led to TIPS, which is Treasury Inflation Protected Securities. But I think a lot of people will be surprised that TIPS are actually negative thus far in 2022, despite the massive CPI prints and all the news around inflation. Duration's been the main detractor. Higher rates detracts from this asset class. And if you don't understand those dynamics and those nuances, you're going to be completely surprised that you're at a loss, despite it being an inflation investing asset class.
And you had touched in the beginning how rising rates are impacting personal finances. And to your point, it happened so quick. I mean, just look at mortgage rates as a great example. Should that affect our investment decisions?
I mean, so again, I would take it back to the plan and your longer term goals. It's going to have an immediate impact. You know, the immediate impact for a person who carries a credit card balance, they're going to see an uptick in that. It's going to be painful for some. If you do have a floating rate mortgage, that's definitely going up. It does have an immediate tangible impact. But, you know, taking it a step further, there's going to be losses across the board in fixed income funds in Q1 here. You know, it's wrapping up here at the end of the week or Thursday. The ag is going to be down something around 7%. It's going to be the biggest loss going back to the 1980s for one quarter, not for the first quarter, for one quarter going back to the 1980s. And the ags never had back-to-back calendar years of losses. Last year, we lost about 1.5 in the ag. Again, we're close to 7. This is going to be a year that really tests that statement that the ags never had negative back-to-back years. But the funny thing about, you know, bonds and bond funds in general is they're self-healing, right? The majority of bonds do not default. Eventually, they make it back to par, they mature. New bonds roll on, they get them at higher rates, the potential for total return increases. And also, we now have a bigger cushion for the risk off events. It's an it's a mechanism that equity funds don't have. Now, I'm not going to say the ag is going to get it all back before the end of the calendar year, not without a significant risk off event, which nobody ever wants. It's unlikely. But those significant risk off events, they come out of nowhere. And when they do, they're very impactful. And that's why we do always recommend holding some sort of core fixed income. It is there when you need it. It has that self-healing nature that I mentioned. And it can definitely improve returns over the long term. But I guess to get back to your question, there are ways to play changing interest rates, not just rising rates, but declining rates. But I don't recommend it. It's just entirely too difficult to get right consistently. If you're going to do it tactically, but definitely involve a financial professional. But I mean, if you just follow me, you know, rates in the past 2 years, we went into COVID. If we use the 10 years as a benchmark, we went into COVID at 190. We quickly hit 50. We got back to 90. We hit 174. We went right back to 120. And you see what I'm doing? There's just too many zigs and zags with this market. Even we broke 2% this year and we went down to 170 and now we're at almost 250. It's too hard for anyone to get consistently right. So we do not recommend playing a rate strategy in your portfolio. Stick to your plan is kind of the point.
Right. And Joe, in the last minute here, anything else of note in the survey we should be aware of?
One of the things that I was at, this is the surprising camp for me, is people's overestimation of the Fed and what they can control and what they cannot control. So obviously the Fed is systemically important. They're the face of every crisis. They're there to kind of backstop a lot of different things we've seen over the past couple of crises. But, you know, they certainly didn't predict COVID. It's certainly something they can't control. They can't control the price of oil. They can't control demographics. They can't control a housing shortage. They can't control people fleeing the cities. The survey really shocked me at what people's idea of what the Fed is to the market. And to me, the Fed is a part of the market, but it's a piece of the puzzle. And again, it gets back to, you know, work with a financial professional, stick to your plan, and never be afraid to ask for help because not everybody knows everything about the market. It's impossible.
All right, Joe, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you. Have a great day.